Welcome back to Oil and Gas Futures 101. This is episode 6, Building a Trade Plan. Over the last 5 episodes, we've covered a lot of ground. You know what futures contracts are. You know how to place a trade. You understand what moves oil prices. You've learned money management and the 1 to 2% rule. And last episode, we went through indicators like MACD, RSI, VWAP, and ATR. But here's the thing, none of that matters if you don't have a plan. A trade plan is what ties everything together. It's a written set of rules that tells you when to get in, when to get out, and how much to risk. Without one, you're just gambling. Today we're building a complete trade plan from scratch. Let's get into it. Before you ever place a trade, you need to run through a checklist. Think of it like a pilot before takeoff. They don't just wing it. They go through every item, every time. Here's what your pre-trade checklist should look like. First, what is the trend? Pull up a daily chart. Is price making higher highs and higher lows? That's an uptrend. Lower highs and lower lows? That's a downtrend. If you can't tell, it's choppy, and choppy markets are where most beginners lose money. When in doubt, sit it out. Second, where are the key support and resistance levels? These are price levels where the market has bounced or reversed before. You covered this in episode 5. Mark them on your chart. You want to buy near support and sell near resistance, not the other way around. Third, what's on the news calendar? Is it EIA Inventory Day? That report drops every Wednesday at 10:30 a.m. Eastern and can move crude oil by $1 or more in minutes. Is OPEC meeting this week? Are there Fed economic numbers coming out? If a major report is about to drop, either wait until after it's released, or tighten your stops. Fourth, how is volatility? Check the ATR on your chart. If ATR is unusually high, the market is moving big, which means wider stops and more risk per contract. If ATR is low, moves are smaller and more controlled. Run this checklist every single time. Now let's talk about when to actually enter a trade. The number one mistake beginners make is entering on one signal. They see RSI is oversold and they buy. Or MACD crosses over and they jump in. One indicator is not enough. You need confluence. That means multiple signals pointing in the same direction. Here's what confluence looks like for a long trade, meaning you're buying. The daily trend is up. Price is near a support level. RSI is below 40, showing the market is temporarily oversold within an uptrend. MACD is crossing bullish. And volume is picking up. That's 4 or 5 signals all saying the same thing. Now you have a reason to enter. For a short trade, meaning you're selling, flip it. The trend is down. Price is near resistance. RSI is above 60. MACD is crossing bearish. And volume confirms. Set a minimum. At least 3 signals must agree before you take a trade. Write that rule down, and stick to it. One more thing, always use a limit order for your entry, not a market order. A market order fills you at whatever price is available. A limit order lets you pick your price. This matters a lot in fast-moving markets. Entries get all the attention, but your exits are what determine whether you make money. You need 3 types of exits planned before you enter. First, your stop loss. We covered this in episode 4. This is your maximum loss on the trade. Use the 1 to 2% rule to calculate it. Place your stop below support for a long trade, or above resistance for a short trade. Never move it further away once you're in. That's a non-negotiable rule. Second, your profit target. This is where you take your gains. Set it at the next resistance level for a long, or the next support level for a short. Make sure the distance to your target is at least 1.5 to 2 times your stop-loss distance. That's your risk-to-reward ratio from episode 4. Third, a trailing stop. This is optional but powerful. A trailing stop moves with the price as it goes in your favor. For example, you might trail your stop by 1.5 times the ATR. So if oil goes up $2, your stop moves up with it, locking in profit while still giving the trade room to breathe. You should also know when to close early. If a major news event is about to hit, like an EIA report, and you already have a decent profit, consider taking it off the table. Don't let a news bomb wipe out your gains. Set your bracket order, stop loss and take profit, the moment you enter the trade. We covered bracket orders in episode 2. Set it and forget it. This is the part most traders skip, and it's the part that separates the ones who improve from the ones who don't. A trade journal is a log of every trade you take. Not just the winners, every single one. Here's what you should record for each trade. Date and time, the ticker, /MCL/CL/QG, whatever you traded. Your entry price and exit price. Whether you went long or short. Your position size, how many contracts. Your stop loss and your profit target. The result, did you win or lose, and how much? And finally, your reasoning. Why did you take this trade? What signals did you see? At the end of every week, review your journal. Look for patterns. Are you losing more on certain days? Are you overtrading? Are your wins bigger than your losses? Are you following your own rules? This is how you get better. Not by watching more videos or buying more indicators. By reviewing your own trades and fixing your mistakes. You can use a spreadsheet, a notebook, or a dedicated app, it doesn't matter. What matters is that you do it consistently. Let me show you what a complete trade plan looks like. This is a real example you can use as a template. Instrument, micro crude oil, /MCL. Account size, $10,000. Max risk per trade, 1%, which is $100. Pre-trade checklist. Check the daily trend on a 1-hour and daily chart. Identify support and resistance levels. Check the EIA and economic calendar. Note the current ATR. Entry rules. Minimum 3 confirming signals required. Signals include trend direction, support or resistance proximity, RSI reading, MACD crossover, and volume. Use a limit order only. Exit rules. Stop loss, placed below the nearest support for a long, or above resistance for a short. Max loss, $100 per trade, which is 100 ticks on /MCL. Profit target, minimum 1.5 to 2 times the stop distance. Trailing stop, optional, set at 1.5 times ATR after price moves $1.50 or more in your favor. Position sizing, dollar risk divided by stop distance equals contracts. $100 divided by 100 ticks equals 1 contract. Additional rules. No trading during major news releases unless already positioned. No revenge trading. If I lose 2 trades in a row, I stop for the day. No trading before 8 a.m. or after 2:30 p.m. Eastern. These are peak liquidity hours. Review journal every Friday afternoon. That's it. Print it out. Put it next to your screen. Follow it every time. Let's recap. Number 1. Always have a written trade plan. If it's not written down, it's not a plan, it's a hope. Number 2. Run your pre-trade checklist before every trade. Trend, levels, news calendar, and volatility. Number 3. Require confluence for entries. At least 3 signals must agree before you enter. 1 indicator is never enough. Number 4. Plan your exits before you enter. Stop loss, profit target, and trailing stop, all set in advance using a bracket order. Number 5. Keep a trade journal. Log every trade. Review weekly. This is how you improve. A trade plan doesn't guarantee profits, nothing does. But it keeps you disciplined, consistent, and in the game long enough to develop real skill. Next episode, we're covering common mistakes and how to avoid them. The traps that catch every beginner. See you there.